Hello everyone, welcome to this edition of Know Your 4C Fund Manager. Today we have with us Mr. Pankaj Tibrewal, Senior Fund Manager with Kotak Asset Management Company. Pankaj is an industry veteran with more than 2 decades of experience in Indian equity markets. He manages some of the largest funds of Kotak Asset Management Company with AUM of upwards of 42,000 crores. And prior to joining Kotak, he was with Principal PNB Asset Management Company as a senior fund manager, managing Principal Emerging Blue Chip, Principal Small Cap, and their hybrid schemes, which are the monthly income plans. Pankaj is a graduate in commerce from St. Xavier's, Calcutta, and a master's degree in finance from Manchester University. Pankaj is one of the top 10 fund managers as per Economic Times, Outlook Business, and Morningstar consistently for the last 6 years. Such a pleasure having you on the show.
Thank you.
Thanks for taking our time.
Thank you. It's my pleasure.
So, Pankaj, before we get on to your investment journey, investment philosophy, we will take this opportunity to get your views on the current scenario on markets, global developments, the local developments, and where do you see markets headed?
So I've always believed that market is a summation of 3 things: fundamentals, liquidity, and sentiment. So let's take all the 3 factors one by one. So when you look at the fundamentals, the earnings season is almost coming to an end, and some interesting trends are to be washed out. First, let's look at the NSE 500 companies per se. 367 companies have reported till day before yesterday. Out of that, 69 companies are BFSI companies, and about 298 companies are non-BFSI companies. In the first 9 months till December, we saw that BFSI space led the entire earnings growth story. BFSI profits grew by about 50%, but the non-BFSI space, which is a large broader market space, actually profits contracted by 11%. So on an aggregate, you saw about 6-7% earnings growth. However, in this quarter, whatever results have been declared, the 367 companies which I spoke about, the BFSI space has seen earnings growth of 28-29%, but the non-BFSI, which had seen a contraction, has actually seen 9% earnings growth, not degrowth. And the margin pressure which we saw in corporating for the first 9 months seems to be abating, and that is reflective on the earnings growth numbers. And by and large, earnings have been better than expectation. And a headline basis, that number is actually in a high single digit number today, which was 5-6% for the first 9 months. When you look at Nifty now, Nifty about 44 companies have reported, and the earnings growth is about 20% odd. So better than expectation earnings, which in turn is reflecting on the market prices as well on the stock markets in April as well as in May. Going forward, we believe that FY24, banking and financial services profit will moderate. It will not be the same which we saw last year. However, the non-BFSI space will continue to see margin expansion led by lower commodity prices. So we believe that less than mid-teens earnings growth could be possible for FY24. And what has happened over the last 18 months is that market has gone nowhere. So in a way, there has been a consolidation and time correction, which is always very healthy. We peaked in September 21, and probably we are in May end. So almost 18 months gone by, hardly any returns in the market. And our sense is that probably next 6 months more, where there could be some volatility related to concerns on monsoons, US debt ceiling debate which is going on, global data coming out may not be as strong as what people are expecting. However, we believe that the next 6 months could be a great time from an overall perspective to start increasing our equity allocation and expect the returns to be in 24 and 25. That's on the fundamental basis. Looking at liquidity, I think everybody got surprised by the FIs coming back in the month of April as well as in the month of May. They have been strong buyers. Our sense is that FI will be there in the second half as well. And just to give you from our experience, for the last few months, we have been meeting with FIs which we never heard about. There are large sovereign funds, pension funds looking to invest in India. They are keeping the homework ready. And interestingly, cumulative, if you look at the last 18 months, for the first time, FI flows have turned positive and markets have gone nowhere. So the valuation correction which they were looking at has happened. Markets are looking much more reasonable. They may not be very cheap, but they are not very expensive also, as the case was 18 months back. So I think flow perspective, I think we are pretty comfortable, both from FI and domestic front. On the sentiment side, I think on and off you could see risk on, risk off. Dollar index has moved again from 102 to 104.5. It came down from 111, and that saw emerging markets in quite a bit of news. I think there could be some volatility being there, and depending on global events, risk on, risk off will play out. But broadly, I think the sentiment for India is by and large positive. So I think from here for the next 6 months, I think it will be buy on dips market. And clearly in this year, we have established the bottom in terms of valuations. So I think that bottom has got established a few months back. And I think from here on, you should start looking to start gradually increasing your equity allocation over the next 6-8 months.
Sure. And global growth is under pressure. Most of developed markets and within emerging markets, the biggest market, China, is also facing headwinds in terms of growth. And that would mean commodity prices would continue to remain under pressure and should augur well for a country like India. And would that mean your margin expansion that has happened for most of the non-BFSI names, should that continue to sustain, and your earnings will also sustain for the coming quarters?
Looks like, because commodity is a tricky game. On one side, the demand pressures are there as the developed markets are slowing down. On the other hand as well, supply in the last few years has not grown to the extent one should be concerned about. You take crude, you take steel, you take copper, you take aluminum. No new big greenfield capacities have come on stream globally, ex of India. So I think somewhere that's playing a role. But as the thing stands today, we can't say never, but as the thing stands today, I think commodity pressures should be behind us. In the next coming few quarters, I think corporate India should see margin expansion from the current levels also, because in many commodities, don't forget, they have inventories which they are using still now on the high cost side. 90 days, 120 days, normally they used to keep inventory. That starts get exhausting somewhere in June, July onwards. And from here on, I think till September, you should start seeing low cost commodity which is prevailing now start coming into production. Sure. So I think margin should be quite comfortable for the next couple of quarters. Only one worry which we have is that WPI has come almost below 1%. It went into negative also. So the last 2 years, corporate India got the benefit of inflation on their top line, which may be absent in FY24 sure. if WPI stays at a lower number. So most of the companies will replicate the volume growth into the revenue growth because the inflationary part will not be there. So we need to watch out for that. Street normally extrapolates the growth into the next few quarters, which may not be the case. So this year I'm not worried on margins, but my back of the mind, the worry is only for corporating is the miss on the revenue side, because the estimates are quite high when you look at the analyst on the street.
Sure. And the rural India has been under pressure for some time now. Do you see a revival coming in there with elections around the corner and monsoons? What is your broad view?
So monsoon is a very big question mark. But over the last many years, what we have seen is the dependence of rural on agricultural is started to come down. What it was a decade back, 2 decades back. Because a lot of non-agriculture work people are engaged in. Construction, road construction, housing construction, and so on and so forth. So our sense is, yes, it will have a minor impact if monsoon distribution is not good, monsoon is below the average, but nothing to be concerned the way we used to see earlier. That's one. The second part is that this time, for the first time, most of the FMCG companies in their commentary and the outlook said that rural is starting to show signs of comeback. Is it completely to the extent which we saw 2-3 years back? Answer is no. But somewhere the bottom has been formed in terms of demand contraction. And I think from an overall election perspective, we did this analysis that over the many years, last many election, the 6 months before election and 6 months after the election, actually FMCG does well and consumption does well because the money gets spent at the rural and the grassroots levels, and that gets spent before and after the elections.
So the volume degrowth that we have seen
should get arrested. There are early signs that volume incrementally should start showing positive momentum, and commentary is also pointing towards that by the large FMCG companies out there.
Sure. And the large caps have done reasonably well. Your mid caps have also done okayish. But your small cap index per se in the last 5 years has not delivered any meaningful returns.
Yes.
While some of the stocks have done well and some of the active funds have been able to participate in those stocks, how are you positioning your portfolios? I mean, since you're focused more on the mid and small cap side.
So I think the approach remains the same. And let me take you 2 minutes towards our philosophy. And I think that will help you and the people anybody who's watching this align what our thought is. So we are growth at reasonable price, okay? But it's very important in the space, in the broader market space where we operate in, that you make less mistakes. And you always remember the Warren Buffett rule: don't lose capital, don't lose money. Rule number 2, don't forget rule number 1, okay? So that's very much applicable to this, because if I give you some statistic, it will be surprising to all of you. In the last 20 years, only 5% of the small caps have become large caps, and only 9% of mid caps have become large caps. So from outside it looks like multi-bagger, great stories, things like that, but don't forget that the mortality rate in this space is also very high. Hence, making less mistakes is extremely important, so that you don't have a permanent loss of capital. How do you do that? So the first thing we focus upon, and I think we have realized over a period of time that in India, the DNA of the promoters play a very important role. And promoters either make or break the wealth creation story of a company. And we try to devote a lot of time in terms of understanding the DNA of the promoter. Is it only one-man show driven? Is it a owner-operator driven, which means that passion of the promoter, risk-taking of a promoter, and working of a professional together? And that combination has created huge wonders in the Indian corporate history when you look at the biggest compounding stories ever, right? So DNA of the promoters is extremely important, and we have tried to bring a lot of art and science to it, making sure that we do a lot of due diligence on through the external environment, either ex-employees, current employees, suppliers, customers, their entire CS ecosystem which we have created. So that helps us on the DNA side. The second big question we ask is it a small fish in a large pot or a large fish in a small pond? Whether the opportunities and the runway for growth for that company is large enough from a 3, 5, 10-year perspective. Otherwise, if it's a large fish in a small pond, very little it can gain out of market share and in the opportunity present. The third most important point is that a lot of people focus on profit and loss account. Our focus is more on balance sheet and cash flows. And we believe cash flows and balance sheets don't lie more often, right? We have believed in this investing mantra that top line is vanity, bottom line is sanity, but cash in bank is reality. And if you can keep on focusing on balance sheet and cash flow, the probability of you going wrong reduces drastically. And that's something we believe that is very helpful in the framework in the mid and small cap space. The fourth thing is that return on capital is very close to us. And we believe that companies which generate returns which is lower than the cost of capital finally destroys value if they try to grow faster. The first thing they need to do is bring your return on equity and capital above the cost of capital and then try to grow. And if you can make selection of those kinds of companies which have some advantage, which has some competitive moat, which is reflective on the return on capital they generate, you will weed out a lot of companies which are not there at all. So for giving an example, there are 5,000 almost listed companies in India. We at Kotak track about 420, 430. And out of that, you create a portfolio of 50, 60 company stock, And we believe in this King Kong to gorilla, a gorilla to King Kong strategy, that have 50, 60 of these companies selected by your framework. You don't know which one will become King Kong, but some of them will become King Kong over a period of time. And by following this and then focusing on valuations as well, that you don't buy at wrong price, be value conscious, that what is the price you are paying for the growth which you are getting. By doing this 5, 6 things, you make sure that your portfolio churn over a period is not more. And that's what has happened to our portfolios both on Kotak Emerging Equity and Kotak Small Cap, that we haven't churned too much. Our churn ratio is one of the lowest in the industry. And that's the reason we have been able to identify compounders which have generated and helped the fund from an overall performance perspective. As we look today, the portfolio is very well diversified. Some of the sectors which we are bullish on are manufacturing, capex related themes, because we believe that India is coming through a trough, and the next few years it's all about manufacturing, capex led recovery. The other theme which we are positive on is the entire home improvement space. We don't bet too much on the pure developers, even we are bullish on real estate, and we believe the best way to play that real estate recovery is play through the entire tiles, plywood, mattress, consumer durable, cement, and so on and so forth. And you have great companies out there with great balance sheets, great return on capital, great promoters, you know. So that's the another space we are bullish on. Auto anchors is another space we are bullish on. Private sector banks, banking BFSI space is another we are bullish on. And one of the space where we think that 4 years nothing has happened could be pharma. But it has to be very stock specific. I think this year will be more sectoral specific, stock specific rather than market as an aggregate. And you need to catch the right trends in all the sectors for you to generate alpha over this year actually.
So pharma as a weight in the entire index is not meaningful. How are you wanting to play? And within pharma, it's an industry in itself, and there are multiple themes that one could play. Yeah. Which are the themes that you are feeling?
So pharma, as you rightly said, we believe it's a stock specific, kind of approach. In pharma, you have domestic businesses, you have US businesses, you have CDMO, you have hospitals, you have diagnostics. So where we are bullish is a combination of businesses which are very strong leaders in India. However, we are seeing some incremental change positive in the US market also. After 4-5 years of price erosion, for the first time we are seeing that price is getting arrested in the US market. Is it temporary? Is it medium term, long term? We don't know. But there are early signs in this quarter results also, where we saw that US actually started making money for few companies, which is the first time in last many quarters. Good encouraging sign. The third space, we have hospitals. We have few exposures to some of the hospitals in India, and that's a great way to write the entire Indian demographic story as well. And last but not the least, the diagnostic one, where we believe that valuations are still not reasonable, they are expensive, and competitive intensity is going higher. Yeah. So we are ignoring that space at the moment. But the combination in pharma, healthcare, I would say will be a combination of these 3-4 sectors which I spoke about. But it has to be a stock specific approach rather than just taking a sectoral call and just riding it through.
Sure. And while I would like to spend more time understanding your investment philosophy and the way it evolved over the last 2 decades, but just for the benefit of the investors who are contemplating adding little more weight to their small cap exposure in the portfolio, do you think it's a good time to?
See, I think next 6 to 8 months could be a great time to start increasing your mid and small cap exposure. But mind you, this space should not be looked from a shorter term perspective. At least this space should be looked from a 3 to 5 year perspective. In between there could be volatility, there could be risk on, risk off. But over a 3-5 year period is a good time where this space generally doesn't disappoint. And last 10 years we have seen that active managers in this space have been able to generate extra returns, alpha, which we say, over the benchmark as well as over the narrow indices, which is the large cap indices called Nifty. And I think if one is bullish on India from a structural perspective, this is the space you can't ignore, because the largest tile company is a mid cap, the largest apparel company is a mid cap, the largest air conditioning company is a mid cap, the largest retailer is a mid cap. So, so there's so many sectors that when your per capita GDP starts growing, this is one sector, space where you have to express your views, right? So I think when I look at slightly from a next 5, 7, 10 years perspective, and your per capita moves from $2,200 to $3,000+, roti, kapda, makan will be necessary, but there will be many more services which you will require. And to express that, it's not available in Nifty. You have to express that through a broader market space. So try and look out for managers, try and look out for people who have a strong track record in this space. Try and see that the downside capture ratio is lower, and if you can protect the capital, this space can be rewarding. So during downturns, you have to protect the capital, and upside you will automatically participate. तो pitch पर रहोगे तो आपको पैसा बनेगा.
Sure. And what's your view on other sector which is more export focused, the IT sector?
So IT, we think that there's a little bit of more pain left, because largely Indian IT companies are dependent on BFSI 1, a large part of revenues, which is not doing that great, and we saw a few bank failures in the US. So there's a cautiousness among those BFSI companies. The second one is on the retailing, a lot of exposure by Indian IT companies. They also seem to be slowing down. They are cutting their discretionary spends. So a couple of more quarters before the IT demand bottoms out. But however, I believe that the cloud migration, which started during COVID, we are still just 40-45% there. So we haven't reached the 70-80% mark, and most of them have progressed during that journey on the transformation. So if you take a 2-3 year view, probably next 3-4 months could be a great time to start increasing your IT weight, because last 15 months you have seen the correction in the IT index as well. Stocks are reasonably valued. The excess froth which was there is out. So next 3, 4, 5 months will be a great time in again a stock specific approach that start increasing your weight out there.
And with the emergence of AI, ML, do you see the dynamics changing in the IT industry?
So I think yes, there is a concern that ChatGPT kind of AI things will disrupt some of the jobs out there. And obviously among the coders there is a worry that will my job be relevant 18-24 months down the line or not. So everybody needs to upskill themselves as you move ahead. However, I believe that this is just an aid to a normal person, and more AI work will be done which will require IT companies to only execute it. So my sense is that these disruptions we have seen in the past also, but the journey continues. And I feel that a lot of India companies are at a very strong position today in terms of delivery, in terms of execution, in terms of growth. If you can get them at the right price, they are free cash generators, you don't have any concern on balance sheet, great leaders in the space they operate in, and I think that could be a great way to ride.
Within IT, you have the giants which have been catering to the large developed market clientele. And then you have the smaller players which are catering to some of the niche services.
Yes.
So what would be your preference there?
See, IT, if you go back into last 20 years, it looks like an easy business, but beyond the sight, it's not an easy business to scale up, okay? Because after $500-600 million, any deal you go in, you will have the competition from large guys also. So that's the reason that in the last 20 years, you have seen 6-7 IT companies in the very high bracket. But all others guys did well for a time being, but then they struggled over a period of time because competition starts increasing with the bigger boys, right? So our sense is yes, there will be 2 or 3 more mid-cap, small-cap IT companies which will enter into a $1 billion revenue league. Our job is to kind of identify a couple of them. In the last decade also we saw a couple of them entering into that league, and also in this decade we believe there will be few IT companies which can, and if you can identify them early on, the compounding which happens in this sector is fantastic. And we did the super compounders study over the last 20 years. IT is one sector which has thrown a lot of multi-baggers. Industrial is one other sector which has thrown a lot of multi-baggers. Consumer discretionary is another sector which has thrown a lot of multi-baggers. So if you can identify from a top down these sectors and then go bottom up, selecting the right businesses, right product company, right services company, I think the outcome could be quite okay.
Sure. Yeah. Now coming to the most important part of the session, your investment journey. I mean, how did you get into investments industry, and how did your journey as a fund manager over the last 2 decades evolve?
So I always say that there's a 3M attached to me. So I am a Marwadi from Kolkata, studied in Manchester, and then in a way did my masters also from Manchester. So 3M kind of a stuff, and I come from a business family.
Sure.
So business has been part of my blood from a long period of time. And when I graduated, actually 9/11 happened. So I moved to Bombay, and I was fortunate enough to get a job in Principal Mutual Fund. I joined on the debt side actually.
Oh,
So I
interesting.
started my journey on the fixed income side as a credit analyst. And over the next couple of years, my interest, really passion lied in equities. So I started, and there's a very fine line between the equity part and the debt part. The only last mile is valuation, and there it is whether the money will come back or not,
Yeah.
default.
Yeah.
But the approach you do for the company understanding, sector understanding is virtually the same.
Diligent is
It's the
similar.
same,
Yeah.
right? So my interest lied in equities, and I took few sectors. And then my boss was very fortunate enough, who is my mentor also, to make sure that I get one of the smallest fund, which was ignored at that point. It was a very small fund, a hybrid fund. Took it, turned it around. In 12 to 18 months, it was one of the best performing fund in the category. Got one more fund out there. Again, turn it around. And the passion and the joy of seeing it grow was fantastic. And every day you kept on learning. Then I got one of the bigger funds out there, which was a tax saving called Principal Personal Tax Saver Fund.
Yeah.
And there again, God was kind enough that we did a fantastic job. And then 2008 happened, and there I said that we should launch a fund when the Sensex was 8,000, and everybody was asking that nobody will give money. I said 10 crores we can get, and sales guy said yes, 10 crores we can get. And we launched that fund, and it became one of the best performing funds in the industry. And I think, if my memory serves me right, that 10 crores when I left in 2010 to join Kotak was about 300 something odd crores. Joined Kotak, the 3 funds which I manage got to me, very small size funds, and you won't believe that the Kotak Emerging Equity Fund was 50 crore fund, right?
50 crores to 27,000 crores.
To 27,000 crores. And just kept on doing that hard work, making less mistakes again and again. The Kotak Small Cap Fund was 80 to 100 crores, if I remember. It is now 9,700 crores. And the hybrid fund. And the latest fund which got added to me 6 months back was the Kotak Business Cycle Fund.
Yeah.
So all the 3 funds had a good vintage, and this 4th fund got added. And this has been a extremely satisfying experience till now. And what we have learned is that over a period of time, you understand that a view of equanimity is very important. That whatever good happens is not because of you, and whatever bad happens is not because of you. And I think over a period of time, I have realized that if your process is right,
Yeah.
if your thought process is right, and you can manage your temperament, and I always say that EQ is better than IQ in markets. EQ is more important than IQ. If your emotional quotient is lower, however good or champion you may be in your IQ, you will not be suited for the markets. So you focus on your temperament, focus on your process, focus on your framework. There will be times when you will underperform also. There will be pressure because we are managing T+1 redemption funds. But over a period of time, if you have conviction on the way on your framework, keep repeating the same thing again and again. It's boring, but keep doing the same stuff again and again. And I always believe we'll make mistakes, but mistakes should not be large enough to wipe out your returns, what you have generated over the 3-4 periods. So don't take any big risk. You take calculated risk, but don't take any big risk. Be very lazy with your investments. Be very patient with your investment. If you think that the company is good, going through a troubled times, they will come out better and stronger. And keep your identification parameters, which I mentioned, closer to your heart, and manage your temperament during good and bad times well. So I think if you can keep doing that again and again, I think the outcome automatically comes out to be true. Most of the people focus on the outcome but not the process, and there they falter. And I think mistakes will happen, but they should not be large enough to wipe out your returns, what good you have done over the few years. So I always say that apart from fund manager, we are risk managers.
Absolutely.
So if we can manage the risk well,
Yeah.
I think it's great. And I feel myself fortunate enough that I'm able to manage the aspirations, the financial status of millions of people who have invested in the fund. And every day I sleep with a satisfied heart that I have made a difference in their lives. So that's something which it comes out automatically.
Absolutely.
And that's something we all at Kotak feel good about it, that this is something which we have been blessed with, and those blessings actually help us perform better and better.
Sure. And was there any change in your approach to investments, some of the early learnings which you brought into your frameworks?
So yes, obviously market teaches you every day, right? And somebody has said it very rightly, forget the mistakes you have made, but don't forget the lessons from those mistakes.
Yeah.
Right? Don't keep a baggage of mistakes, but keep lessons very fresh in your mind, so that you don't make those mistakes again, right? So very early on, yes, that was the time when real estate, infra, everything was doing great.
Yeah.
All the cash flow companies were not doing great. So mistakes were made by investing in companies which didn't generate cash flows. Only growth was the mantra for them. And learned through making some mistakes out there that only growth without the required balance sheet and cash flow has no meaning.
Sure.
And I think that time we saw that many of those companies which were called as those multi-baggers are no longer even penny stocks today. Many of them have vanished also.
Yeah.
So early on, kind of paid a small tuition fee, but learned it very early on from a framework perspective, that growth is important but not at any cost.
Balance sheet and cash
Cash flows are more important than P&L.
And the multi-bagger stories.
Multi-bagger story, absolutely. And if you can keep that thought process in your mind over longer periods of time, there will be phases where this approach may not work. Like last 12 months you look at, a lot of value stocks have moved up,
Yeah.
right? They may not be the best capital generators, they may not be the best balance sheet or cash flows, but people have lapped upon from a growth perspective. Time will suggest that over the next few years whether sustainability of those returns will happen or not. So one needs to be very aware of the fact that every approach will have periods of underperformance as well.
Yeah.
And this kind of was a learning in 2003 to 8 phase as well, that many companies which were not generating cash flows were the darlings of the market.
Yeah.
And we also made our share of mistakes there.
Sure, sure. And now on this topic of growth versus value, over the last 1.5, 2 years, it's value that has outperformed growth. Do you see that revival of growth coming back now? I mean, we discussed initially.
So I track the data.
Yeah.
So there's one interesting global value growth funds data. And in May 2021, for the first time, value started outperforming globally. And whatever happens globally, with a 6 months lag, that style starts to work in India as well.
Sure.
That's our experience. We saw that happening in May 2021 in US, that value underperformance had reached a bottom versus growth. And then value started performing. When I look at this data just few days back, actually for the first time again, value has started underperforming and growth has started to make a comeback. And in this results also, in India as well, you are seeing that some of those value versus growth argument is taking a backseat now. And growth names have actually started outperforming,
the sectors,
both on earnings and sectors as well. So I think there is a reasonable probability that once we get a sign that interest rates are not going to go and increase anymore, I think, and people will then start, extrapolating that interest rates will start reducing sometime next year if demand is under pressure, I think growth stocks will make a comeback. But my only advice is that people have been spoiled over the last decade because the interest rates were virtually zero, right? So you give any P to any company, right? And virtually everything just went through the roof. I think that same madness will not repeat again. What the madness we saw for pre-COVID, before when the interest rates had come down. I think this will be growth at reasonable price because the cost of capital has moved up reasonably well. 1.5 years back, for 5% generation in US, you had to invest in junk bonds. Today that 5% is available on a US Treasury, risk-free rate, right? So why will you go in a higher risk? So the cost of capital has structurally moved up. And that cost of capital will make sure there is an upside gap to the price to earnings which we give or the multiples which we give because there's a cost of capital argument out there. So I think, yes, growth will come back, but don't expect the same madness where we saw infinite Ps, people just saying there's no cost of capital, people funding the startup world like crazy, venture capital was the big game, Bitcoin was another big game, cryptos was another big game. So all those excesses have been wiped off and still some pain is left in that space in my view. So be careful when you evaluate companies. Don't be in a greater fool theory that buy at 100p, some joker will come and buy it me from 150p. That will not work. So growth will make a comeback, but growth at reasonable price should be the style one should be focusing on.
Is there any definition of reasonable price in your framework?
So we look at PEG.
Okay.
So rather than doing an absolute number on the PE ratio, I think PEG is more important. And time and again we have seen that if a unit of growth is there, and what price you are paying for that unit of growth. And generally in India we have seen that PEG up to 1.5 times make reasonable compounding for you. If you overpay anything above 2.5 times on PEG, probably you will see, time correction over a longer period of time, assuming it's a quality company. If not absolute price correction, time correction for sure. So I think PEG of less than 1.5 is a reasonable sweet spot to be in, and that's what we define growth at reasonable price.
So in your portfolios, you're essentially looking at promoters with passion, backed by professionals with execution capabilities.
Absolutely.
Strong balance sheets, good cash flows, and also PEG, preferably less than 1.5 times.
1.5 times, or maybe at times less than 1 time, actually. And that formula, I think, has been a kind of a magical formula for us. At times, you can't tick all boxes.
Right.
But most of the boxes of it get ticked, and especially on the promoter side. I again repeat, in India, in the mid and small caps, in the broader market space, 80 to 85% is promoter, promoter, promoter. If they are right, the DNA is right, don't worry about
The short-term
near-term, short-term underperformance. And they will come back. They will make sure that, because it's such a large country, such large opportunities, and if you can get the right jockey, don't worry about anything else.
Sure, sure. No, thanks so much for
Thank you.
all your insights on markets, macros, different sectors, and within sectors, the sub-sectors, and your framework and some of the funds and the positioning. So I'm sure our investors and viewers will find immense value out of it. Thank you so much,
Thank you
Pankaj.
for patiently, taking us through the process, and I'm sure that viewers will have some value addition over a period of time.
Absolutely.
Thank you.
Thank you so much.
Thank you.